Hello. In the final of our series about small business CGT concessions, we'll talk today about the Rollover Relief Exemption. Again, to make use of this exemption, you must meet the basic conditions, so the 6 million and the 2 million that we've referred to a couple of times already. Further, certain rollover conditions must be met within what we call the replacement asset period. Now, this period commences 1 year before the disposal of the asset and ends 2 years after the disposal. Within that 3-year time frame, if you acquire a new CGT asset as a replacement for an old CGT asset, or if you make a capital improvement to an existing asset, the exempted capital gain can be as much as the cost of the replacement asset and the cost of the capital improvements to the existing asset. So let's look at an example to illustrate that. If Tom makes a capital gain of $80,000 on an active business asset and he meets the basic conditions, he disregards the whole capital gain under the small business rollover exemption. 2 years later, and after the end of the replacement asset period, he doesn't have any replacement or capital improved assets. Therefore, a CGT event happens and Tom makes a capital gain of $80,000. Another example to illustrate this exemption is where Tom makes, let's say, a capital gain of $700,000 on an active business asset, and again he meets the basic conditions. He chooses to defer the whole capital gain. 1 year later, Tom purchases new business premises for $300,000 and he spends $150,000 improving those business premises. So his new total expenditure is $450,000. But he deferred previously a capital gain of $700,000. This means that 2 years after the original sale, which again falls outside the replacement asset period, Tom would make a capital gain of $250,000. Tracy Ferguson, thanks for listening.